Todd, great to see you as ever. So, you know, they're turning positive. What about you?
Well, we're recommending underweight China and India, and we're only seeing 10% maximum upside over the next 12 months. So we're definitely
staying... That's best case scenario is what you're saying.
That's best case scenario. And we also think there's concerns about inflation, that the economy's slowing. I don't think the markets are pricing in some of the potential bad things that can happen when economies slow down. So this is where we're at right now.
Well, I just play devil's advocate and say that the Chinese authorities will reply saying, well, they're going for qualitative growth, not quantitative growth, and that inflation, as we've known about it, that it's already been priced in.
Well, I would say what happens if inflation stays above 5 for a sustainable period, let's say until early next year. We're calling, or our economics team is looking for 2 more rate hikes, 3 more reserve requirement hikes until next year. And then actually we're looking for another 2 going in 2012. So a much more further extension of the tightening cycle than I think some of your more bullish brokers out there.
But that leaves real rates pretty much neutral, doesn't it?
Agreed. I mean, we do have real rates that have been somewhat negative. You still have a property market that's showing positive signs in many of the cities. So I don't think China wants to let things loose and allow liquidity to start taking off again when you have a property market that looks like it's still biting at the bit that it wants to go. So I say things stay tight until 2012. I think earnings growth forecasts of 21% is way too high. I think you're probably going to see closer to 10 to 15. Already interbank markets in China are showing more signs of tightening. And I think downgrades and some more bad things that potentially happen when things slow down.
Yeah, and they're taking more and more liquidity out of the system with the reserve requirement keeping on rising here. So, and also, what about the mood of investors in China itself? They see property surely as a better bet than the equity market.
Well, look at A shares versus H. I mean, one day yesterday you had H shares up 1.5%. A's were down 1%. I haven't seen that in months. And that just shows you that, I guess, foreigners are really hoping to get in at the bottom, might not be pricing in some of the risks. And whereas, like you said, locals maybe would rather take another punt on a property than go and put a bunch of money into A shares.
If they can.
If they can.
Yeah. What about also just the credibility of some of these companies too? That's coming under question of late. We saw Li Ning and we saw, of course, the resignations there at the top.
Yeah, I think that's a serious issue. I mean, Li Ning has had a business model that's been working, and then all of a sudden you have several senior executives resign. There's questioning of whether a major Chinese brand going up against foreigners is doing a competitive job. You have questioning last week on Chowda and its accounting for properties. And then one of the great companies of Asia for the last 10 to 15 years, Liam Fong, where you have, they did a miss at the full year results. People are now questioning how they're accounting for acquisitions, whether they can manage their costs. They've done a great job in the last 15 years, as I said. But this is a stock that's seriously corrected. And this is what happens in downturns. People start questioning business models. People start questioning earnings. And bad things can happen.
Even more so when you get some of these Chinese companies which are listed in the U.S. by reverse takeovers.
Yes.
Now, that's another thing of concern.
It's a major thing of concern. That's been going on for a longer time. That was happening in the second half of last year. And there's been several reports, some very good reports done on this. And it's also questioning business models and accounting policies and the potential for fraud being unearthed. So, yeah, this is standard stuff. When things slow down, you end up with questioning. And when questioning happens, risk premiums go up. And China right now, H shares do look cheap on a 2012 basis. They're on 9 times earnings. But what happens if those earnings don't grow by 20%? They only grow by 10. I think there could be some disappointed people. And we could have a pretty, all I'm saying is that we could have a pretty bumpy 6 months.
But you like the banks, don't you, Chinese banks?
I've had an overweight on the banks. I'm taking a look at that again because if we go into a more serious downturn, I mean, China's credit's doubled in the last 5 years. They have NPLs far below 1%.
It's amazing, isn't it?
It's utterly amazing. I think it's the first time you've ever seen credit grow by double digits for a 3 to 5 year period and not seen NPLs go to, at the very least, 1, 2, 3, 5%. So that's a question. And I just think you should be a little more conservative. I think looking at things like IPPs, the steel sector's had a brutal 6 months, and they've had costs go up with iron ore. That sector's underperformed by 27%. If I was a long-only fund manager, I might be actually dipping into some of the steels just because they've gone down so much. But I'd be taking a more value approach and looking for value as opposed to jumping on top of growth just when I think growth is going to get cut.
Todd, always a pleasure, never a chore.
Thank you for having me.
Todd Martin from Societe Generale there.